Hello and welcome to Let's Talk Business. I'm Priyanshi Sharma. In this show, NDTV and BQ Prime will bring you the top news stories from the world of business, finance and economics. Let's first start with how the markets performed today. And markets made a sharp recovery to end on a high note. Fag end buying drove Sensex up 346 points to 57,960, while Nifty rallied 129 points to reclaim the 17,000 levels. Meanwhile, the rupee weakened against the dollar, depreciating 15 paise to close at 82.34 against the greenback. Let's go across to my colleague Neeraj Shah in the BQ Prime newsroom to get a wrap of all the market action. Over to you, Neeraj.
Thanks so much for that. So the global markets dictated this, you have to admit, because when we shut shop, Europe was in the green. Dow futures were up about 250 odd points as rates have fallen. So the global market mood was very sanguine. But you have to understand that for the last 3 days, the global markets have been okay, but we haven't done well. The Nifty shut below 17,000 for 3 days on a trot until yesterday. As of yesterday, it's just today's session. There's a bit of a spring effect that the markets haven't been doing well for a while, and they've come back, or they finally made a point to move up. And it was a broad-based rally. From HCL Tech, as an IT name, to a Tata Motors, which is an auto name, to banking names. It was a widespread move. Only Reliance and Airtel were the notable stocks on the losing side on the Sensex. The Adani Group stocks, which is kind of dictating sentiment of sorts at the broad end of the spectrum, did really well today after the clarifications from the company yesterday. So Adani Enterprises, Ports and the others had a fairly decent outing. At least the two main names had a fairly good outing in the session today. And the broader end of the spectrum, we saw gains. Remember, mid caps and small caps have been sulking the last few days. In today's session, everything from an NBCC, which went up 13-14% on back of 150 crore orders. It's not that the order really dictated it, but just that the sentiment improved a little bit. You had sugar names like Renuka, capital good names, Praj Industries, PSU Banking, UCO, Union Bank, Bank of India, and the whole PSE index. You had an SJVN and some of the other PSUs also doing well. So net, a broad-based rally, much needed. The question is whether this will last. Tomorrow is a holiday for us. Let's see if we actually build on from here come Friday.
Right. Well, thanks, Neeraj, for joining us with those details. And moving on, now we have some bad news for your budget. You will have to shell out more for essential and life-saving medicines now. While inflation was already burning a hole in the Aam Aadmi's pocket, now medicines too will cost 12.12% more. This is in fact the biggest ever hike announced by the centre. My colleague Monal Sanghvi is joining us for more details on this.
The National Pharmaceutical Pricing Authority has approved a hike of 12.12% on essential drugs that are covered under the Drug Price Control Order. Now, this would mean that life-saving drugs are all set to get more expensive. This hike is usually based on the wholesale price index of the preceding year, which is reflective of the inflation in the economy. Now, normally this would range between 0.5% to 4.2% in the past couple of years. But last year and this year, it's been a double-digit hike, with this year being the highest and effective from April 1. However, companies that have a higher exposure to the national list of essential medicines are all set to be key beneficiaries. Some of these companies include GSK Pharma, Sanofi India, Ipca Laboratories, Alkem Laboratories, Alembic Pharma, amongst many others, and FTC. Now, these companies have an exposure ranging from 15% to 49% to the NLEM. And it's usually seen that acute therapy-oriented companies have a higher exposure to the list, so they're all set to gain. Now, here's a small catch. Vishal Manchanda, a pharma analyst with Systematics, says that GSK Pharma and Sanofi have had a couple of their main products recently been included in the January updated list of the NLEM. Now, this would mean that they would have had to take a downward price revision. Now, despite this price hike, they're saying that it's not sufficient to offset the downward revision that they have had to take. And this could mean that their revenues would still be at a net loss compared to their last year's revenues. However, for all the other drugs that have been on the list for quite some time now, this is going to be a big gain for the companies.
Right, thanks very much for joining us with those details. And now moving on, amid ambitious capex targets, the fiscal deficit of India's top 10 states is likely to see a decline. The fiscal deficit of states ranked by the GDP is likely to ease to 3.2% of the GDP in financial year 2024. My colleague Pallavi Nahata is joining us for more details on this. And Pallavi, take us through those interesting numbers.
The fiscal deficit of India's top 10 states is likely to marginally decline in FY24 according to a study of their state budgets. Alongside, capital expenditure is likely to see a surge, though whether or not states will be able to meet their targets remains to be seen. An analysis of state budgets when states are ranked by nominal GDP shows that top 10 states are likely to see a marginal decline to 3.2% of the GDP in their fiscal deficit from 3.3% of the GDP in FY23. Alongside, expenditure is likely to see a rise of about 11%, while capital expenditure is likely to surge by over 25%. However, an analysis of state spending by ICRA shows that up to January 2023 in the current fiscal year, 15 top states have only been able to spend about 54% of their allocated capex. What does this mean? It means that states are unlikely to meet their targets for FY23 and they're unlikely to meet their increased targets for FY24 as well.
Right, thanks very much for joining us with those details. Now moving on to the other big story. In a major setback for Google, the tech giant will now have to pay a penalty of 1,337 crore rupees imposed by the competition watchdog. Now dismissing the plea against the Competition Commission of India's order, the appellate tribunal has directed Google to pay a penalty within 30 days. NCLAT held that Google must pay for abusing its dominant position in the Android market. It has also rejected Google's plea that there was a violation of natural justice by the competition regulator in the probe. My colleague Payaswani Upadhyay joins us with more details.
Thanks, Priyanshi. Well, the big headline, of course, is that Google has been found guilty of abusive conduct and the penalty of over 1,300 crores has been upheld against the tech major. But it's only a partial victory for the Competition Commission of India. I say that because the NCLAT has set aside 4 out of the 10 corrective measures that the regulator had asked Google to take. And the 4 that have been set aside are quite material in the commercial sense. For instance, NCLAT has said that Google doesn't need to distribute other app stores on its own Play Store. So a player like OS Lab, which contested that it was driven out of the market by Google, that remedy has now been taken away. Secondly, NCLAT has also said that it's not necessary that users be allowed to delete pre-installed apps like Google Search or YouTube that are found in the Android ecosystem. Users can just choose not to use these apps. Third, NCLAT has said that Google doesn't need to allow side loading, which allows users to download apps from, let's say, websites and not from Play Stores. Finally, the direction that Google must provide APIs which are required for other versions of Android to be compatible with the app universe has also been set aside. So in omitting these directions, the NCLAT has essentially diluted the measures that the CCI had asked Google to take. Some quick conversations with experts also revealed that the order of the NCLAT is now not going to significantly change Google's life vis-a-vis original equipment manufacturers or smartphone manufacturers. That said, this is just basis the oral pronouncement. We are yet to sort of fully read the 200-page order. Both CCI and Google may choose to appeal this order before the Supreme Court. We will, of course, stay on top of that. Back to you, Priyanshi.
Right. Thanks very much for joining us with those details. And with that, it's a wrap on this show. Thanks very much for watching. Do tune in at 5:30 p.m. every Monday to Friday for all the top business stories of the day. Goodbye.